Greetings, market rebels. Welcome to this week's macro measure. I'm Wayne. My partner Ryan's working on the market outlook overview for the week. It is Sunday, February 5th, 2023. A little bit after 2:30 in the afternoon here on the East Coast. Going to flash our trusty, or am I? Come on. There we go. Trusty disclaimer for 2023. Please have a quick look at that for us. And please have a quick look at the intellectual property rights notice as well. And thank you very much for doing that. Going to do a quick, let's see if I can do a quick switch over here to a different screen. And then we'll do a very quick recap. And I'm going to try to do a very quick macro measure. And that's really regrettable because, in a way, because I did a very extensive one that I had a problem recording. Thought I had just completed it, and oh well. And somehow I must have either misclicked or whatnot. It's the way it goes. But I did want to start on a quick recap first. So let's take a look at the SPY chart. And I think we played last week smartly. That is sometimes a little frustrating, and sometimes it's a little boring. But I think it pays off far more than it doesn't in the end, in the long run. Here's Monday, there's Tuesday, Wednesday, Thursday, Friday. And we said, look, tough call, because who knows what's going to happen with the Fed, right? Overall, we've been noting that the bulls continue to take more and more control of this market. And we've been talking about that for quite some time, literally months, but certainly even more so after they put this base camp in and started to work their way up and through. So that's been the big news. 2023 has been a tremendous year. In the video that did not record, apparently, I spent a lot of time going through many amazing UOA finds from our UOA team and some of the stuff we've had in UOA Pro. Just incredible movement, ton of opportunity. And I'm encouraging everyone, I don't really ever say this, but I really think everyone should inquire about that. You have no downside. You know, if you've never done it before, if you have experience, you feel like you can handle it, it's probably at least worth a look just to see the kind of things that they've uncovered, because it's been an absolute bonanza, I think, in terms of opportunity. And I think you're looking at maybe about going back about, I don't know, 18 to 12 months ago, prior to the start of 2022. Really, for that kind of incredible performance. Probably have to go even further back. Probably really you have to go back to the second half of 2020. It was just a remarkable, this has been remarkable with the stuff that's happened in the short squeezes we've seen in the UOA that's preceded it. And it's just been remarkable. But anyway, getting back to the here and now, we kind of said, hey, look, we don't know what the Fed's going to do. We can talk all we want about the technicals, but great bullish things could be undone by the Fed, and great bullish things could be amplified by the Fed. And as all of us know at this point, between the Fed and those mega cap tech earnings, really, I don't know what the celebration was all about, but the facts remain that the market took it all in stride in the end. And clearly bullish, right? They ran stops, took out highs, ran stops, and reacting after that, I think, was better than saying, okay, well, I'm going to guess in front of it. But you could still participate there on Tuesday, I think, because you could trade right all the way until 2 o'clock on Eastern time on Wednesday without really having big Fed worries. So there was opportunity there. But now, after kind of, I think, playing it smart and safe, now we have to say, well, what happens this week, right? And so I've been noting that there's sort of a head and shoulders inverted one, that is. I'm not the only one saying this, obviously. Some people are going to see kind of like a cup and handle type of thing, whatever you want to call it. There's bullish patterns in place. I think it's really evident in SMH, which is a very important kind of leadership sector. And as far as inverted head and shoulders patterns go, this is a fairly clear one, I would say, right? You can see back in here where you're at now. So The reason I'm bringing this up and the fact that there's sort of a triangle forming in there, there's a lot of stuff going on. All kinds of patterns or bullish patterns, I think, are forming. But, right, what I would say is that patterns are awesome when they fire and you do very well with them firing, but you have to be cautious, right? That if you see a pattern that tries to fire, fails, and reverses, the gang can really, really reverse things very harshly, very quickly, which means there's opportunity for both patterns that fulfill and for patterns that fall apart. So you just got to be, again, have a mercenary mindset, be open-minded, be ready to go with it. But that tells me that, there's more opportunity in place, right? Especially in an important sector like that. So that highlights the big pattern that's there. Will it fire? How far will it carry? If it does, will it be a fail to fire and a reversal? How far will that reversal roll over to? I don't know. But that's the kind of stuff I'm thinking about. And what I would say in terms of macro measure and the SPYs is, I still think the bulls are in control. They got a little short term, I think, ahead of themselves. I think they're front running a lot of good news, mainly the Fed pausing. That's fine. We can cover some of that real quickly. I do think it got a little bit out of control in the short run. I'll show more on that. I kind of forced some bearish ideas on SPY and QQQ in UOA Pro on Friday because I wanted folks to be able to take prior bearish trades, ideas that did not trigger, and then work with them from a higher trigger level, which was fortunate. But I got them in time because the market did eventually reverse, and kind of an ugly candle, I think, right there if you're a bull. But it did find support, I think, right near or right about where we think it should have or will. And so I think you got to wait for this level here, the 410.80 to crack. Next one down, I think it's going to be right near 409, and then 407. And this sounds like, well, who cares? Like, these are 1 point away, but that's just where it is right now. There's nothing I can do about it. Every buck or two, there's support until I think you get down to this other support line that I've got drawn in here. And I would say, look, if 407-ish does not hold below there in the early part of the week, I do think there's a shot it trades down to the breakout trend line. It could go all the way back towards that 403 to 400 range. And that would be a rising 20 SMA there in blue that could need it. So I'd say somewhere between 400 to 403. Next one will be 407. And then 408, 409. So there is some nearby support. If the market observes it or not, we just do not know. But I think things got a little vertical on Thursday and Friday. I think they're due for a little bit more of a pullback. I think there's a little bit of a quiet week. Now, this is really what I would call the most likely scenario in my mind. Again, not really a forecast, but I think other things can happen. But I think before they try to do more and run, even more stops than they have, and maybe even fill these gaps, which I think they could, I think they're going to let this thing back off a little. I think it could be a relatively quiet kind of give back week a little bit after what we've seen. And of course, the less the bulls give back and the more they hold it, the more impressive of a showing that will be. But I do still think there's a possibility for a bull trap. I do think that 431, 70, whatever, 73 level, somewhere around there. I've got a lot of things telling me this level near 431 is maybe a little bit higher if you want to say, well, they're going to exceed it a little bit. If they're able to do that, I think they're going to really pull a lot of people in. I think they've already really pulled a lot of people in who are just long side players, all about the FOMO, don't want to miss out. They'd rather throw more money at it and buy rather than play it prudently or safe and wait and see. And I also think there's been a lot of people poorly positioned. And you know what happens when Wall Street gets almost everybody on one side of the boat. So that's what I think what we've seen. I am not saying that I don't believe a new bull market can start. I'm not saying that at all. I'm just saying I just don't believe it has yet. The jury's out as far as I'm concerned. I don't think this little excursion up here running above highs is anything extraordinary. I do think there's still more potential of the upside. I think it's going to be probably my guess right now is it'd be more of a shallow pullback and they at least try one more time and try to work this up, much like here, where you get this pullback and then they try one more attempt at least. So I could be wrong, of course, but I think it's more of like more or less supposed to be that kind of a thing. Pull back somewhat, try to go again, and then see what happens. But this week is relatively quiet compared to what we just went through. So maybe in the absence of big news that really chapped the Bears bad, even though the Bears were probably not really that wrong about it. Despite that, right, they just gunned everything. So that's where I'm leaning. But I think what's more important than the chart at the moment, or maybe at least as important, would be this right here. And so this is something we've looked at before. Look at the percentage of stocks above the 20, 50, and 200. And you can see that we're up there. These have typically, on these charts we're about to see, these really, really big spikes have typically coincided with at least short-term highs. And so we just got there. We're very close where we were on Thursday towards a lot of these highs on that particular measure. We can look at the 50-day percent of stocks above the 50-day. You can see this is going back a little bit and you're up here. And I'll show you where we are exactly. I don't know why they keep this over here. I wish we could I don't know if I can make an adjustment on that. Move to, no, I'll let it go for now. I'll play around with that later. But it's way up there, right? You can see the dotted red line as to where you are right now, really. But you've got to go back to get towards levels like this. You don't see these that often. And remember, this is like right after this, the market really got knocked down hard. So you've got to be really cautious now. I'm going to show you a few more things. Same thing here on the 200% of stocks above the 200 red dash line. It's way beyond anything that we've seen since we started really selling. The sell-off really began in early 22. They've cleared out a lot of highs here. A lot of highs have been cleared out. So that kind of argues in favor of the bulls, I think. But it also suggests to me that a lot of players have bought in across the board. And if this is a bull trap, it could be very forceful on the way back down because so many people at this point have apparently joined the party. They've really joined in and are buying up a lot of different things. Now, we say it every week, but we look at it, but CNN's Fear Greed Index, not an infallible little thing here, maybe not even the best one out there, but it's something we can look at and you can see where we are. And most of the components that go into this are in greed, or extreme greed, right? So that's something to keep an eye on. And the timeline view shows it, I think, even more clearly of where you are. Now, naturally, Thursday was a little worse than Friday, but you were at 79, that's pretty darn greedy. And it's not something that you just immediately start shorting, right? But it's just a good idea. I always talk about knowing where you are, knowing what context you're operating in. And that's, even without looking at this, I was able to say on Cocktail Hour that I thought we reached some short-term extremes, having not even reviewed these things at that point, just because my sense of, what I was seeing on different measures on my own charts were telling me that. But here's a good view, right? Over the years, you don't really get much higher than this for much longer than we are right now. It's typically short-lived. So this is also flashing, right? Market sentiment, greedy, extreme greed, whatever you want to call it, on this alternative approach. I jumped out to the summertime, and you can see that right now the current target rate's 450 to 475 for the Fed. But right now they're saying, okay, probably go up. There's at least about a 29% chance to go up a little more. What about a full 50 potentially from here? And it looks like that's your winner. So the chances are, I think the way the market's got things priced, they're thinking that things really peak out still, just maybe 0.25 to 0.50 higher, and that's it. And from there, right, they don't have it going up much more than that all over the next several months. So towards the second half of the year even. So that's where we are on that. So again, I think they're they're thinking, okay, it's over, but is it, right? Is it really over? We'll see. I mean, even if it is, does that mean that everything's all clear, even if the Fed is over? That's the thing. I think they're really, really front running, but I did mention this on Cocktail. Quick review. Here's your pre-election year, right? Pre-presidential election year in green. And you can see this really, really, this third year of the first term tends to really outperform the other years dramatically. And the way that the seasonality works out for NASDAQ or for the S&P, you can pretty much see the year gets off to a very good start. I mean, you have to go all the way through the earnings that we start to see before you really start to get into like the corrective phase, like just kind of like nice trending action with some minor corrective action on the way up. And then you get more corrective consolidation from the second half of the summer into the fall a little bit. And then again, all the folks that front run these buyers are buying in here, right? That's the way the market works. But you can see that a little bit better on Ed Yardeni's charts that he put out on this, his graphics. Notice the 13.5, right, for the third year. So I just wanted everyone to be reminded of that this is really the best year. And the other factor about this is that when the preceding year was so rough, and last year was very rough, that tends to amplify the return of the third year. So even though, you hear me talking about it, maybe yourself, you think, hey, we're still in, I don't care, I still see the economy being vulnerable. I would agree with you, right? But we have to respect the charts if we're trading. And I think even investing, you should respect the charts too. And the charts usually sniff out things better than I do with my economic take. So I defer to the charts. And here's your typical year, right, in terms of seasonal performance, and kind of confirming, right, overall, this is, if we even got that strong year, like I said, they're buying late in the year to front run this part, but this is the best, these are the best times, right, all the way up until, as they say, May. And then you tend to kind of go sideways and correct a little bit, and then you tend to go higher towards the once you're into the fall, and then it carries over. So what we're seeing here is nothing, again, not the most recent data, but that's still about 30 years of data there to take a look at. So I'll come back to this. I just want to share a little bit. I won't have time. I may end up making a separate video for anyone that's interested, but we'll talk about the opportunities that we've seen in UOA Elite and UOA Pro, UOA Essential, even TNT, Rebel Weekly, and Rebel Pip. But the trading, I think, this year has been remarkable. I think there's been incredible opportunities, and I'll try to just tick a few of those off towards the end of what we're talking about. But I think it's really important that we cover what we did there, because sometimes we get lost in the real short run, and which is understandable to a degree, but you really want to appreciate where you are. And I think we're just in one of those times where they may have pushed a little too much, and we need to see a little more of a pullback. And IWM, I'm just going to cover the main major index ETFs for us here. But IWM, I think, got a little bit overdone. You can see it's still high on RSI. Now, most of these things are not as frothy as you would think, and at least I would think. But that is because, right, the way that they backed things off on Friday was pretty strong. So I think on Thursday there, my bad, Thursday in the SPY, it was a little crazy. But when they got this turned over hard the way they did, I think that was very good, that they were able to do that. And I think that backed off a lot of the RSIs that were really very high actually here intraday near the highs. I think that took those intraday, it's sort of like the 2-hour, 4-hour charts, into levels that were much more reasonable. So I don't think they have to do a massive correction here. I'm not ruling out that they won't pull back in a big way. I'm just saying that the bulls don't really have to let things pull back too far to take a lot of really not have a frothy situation. Very little bit, maybe like another 1% would pretty much, I think, do do it. Like that wouldn't leave us in anywhere near froth. And being able to rally from the middle ranges on the RSI is a lot easier to do than when you're already like, hey, 75 or 77 on the daily on something that's a big index like that, which is a big deal to get really, really high on things. So going back to IWM, I think it too got a little ahead of itself. I mean, we had bullish ideas and bearish ideas on these, so they both performed, fortunately. So hopefully we're going to get some really good reports from folks tomorrow and on Thursday and some of our EOA based services, but well, Tuesday too. But yeah, this got a little ahead of itself, I think. I mean, I think a little bit of a pullback here is in order. And then you see what happens. And right, the bulls are now above all the SMAs, as we can see in these things. And the longer term ones are sort of flattening out, the 100 through the 200, but the 50 on up are starting to really upslope. So right, this would be like if you pull back, it's better if you're a bull, it's better to meet a rising SMA, right, than a falling one. And I think that's what this is set up to do. And then you have to see, well, is it more of a fake out than I thought? I thought it had more legs. If it can't hold on, but I think the natural place for the SPY to pull back, which is my main focus week in, week out, and we do that instead of the SPX for anyone that's new, because that way people can trade if they see something on here more easily than trading SPX options. Excuse me, but getting back to here, I think that this 20-day would be the big thing, right? I think I would be curious if it can't hold the 20-day, the rising 20-day in blue. I think that would be a big deal. But as long as they're able to pull back and hold somewhere above there, I think then you got to give them the benefit of the doubt for now. Some of the projections I've got have us overall hanging pretty tough in February after a little pullback, and maybe reaching some up to that 431 level there. But we talked about 431-ish in SPY. That would be my, I think, great fake out level. Now this one, what about the upside here? This is clearly your next one, right? You've got to see if this can come back into here and work its way through 202, roughly speaking. So 201.99 is your number. If it can do that, great. It's got to hold on to it though, of course, too. But that would probably be a great fake out if we are sort of in the midst of observing what will be a bull trap in the end. Don't know. Right? We just don't know yet. Let's take a look at the Qs. We had a really strong push and reverse as well. And I think, right, probably if you're a bull, even you may as well see that gap get closed right there and say, yeah, well, the gap's closed. It's not gonna hurt me in the short run, right? So wouldn't be a bad idea for them just to pull back a little bit more. Again, I think 1% from here is what I would expect as a minimum still. That's what I put in Rebel Pit and kind of put in the ideas that we put out in EOA Pro. I thought we'd get at least a few percent more of a pullback from where we were at the time. And that's at least 1% more here. And what can you say? What else can we really say about this? Because it's cleared out the highs, right? Now, I'm pretty sure when this was happening, I just saw them just running stops. I think a lot of people were like, well, I'm going to give it some room if it gets through here. But hey, if it gets through this high and cash me out, I got to lick my wounds. What do? This is what they're very good at. Running stops. I just saw all kinds of ticks flashing, all kinds of activity above that high. I think they ran people pretty bad, and then the rest. They did the old rug pull there on Friday, but this gap is now closed. That's over and done with. This high was exceeded, but that's we know from experience, right? That's what these guys do. Hey, this is rolling over. I'm going to short Qs here. Okay, I think it's going down more. You hold on too long and wait. What do? They exceed the high maybe you traded against, and then the whole thing falls apart again. And this is just what they do. So, we have to anticipate that these things are maybe not only possible or highly possible, but maybe probable or likely, just because of how these guys whip things around. And like I said on Cocktail Hour, they really use the economic calendar as their time roadmap in which to do things, if you ask me. And that's just been my take. Like, they'll justify anything they want to the financial press, who will go out there and spin it that way as best they can. And meanwhile, it's a bunch of nonsense. I mean, the Fed really didn't do anything super dovish, I don't think. And I'm not a Fed expert, but those earnings from Apple and Amazon and Google weren't stuff to write home about. Didn't matter, right? They still goosed it all the way back. In fact, they had things positive on Friday at one point in most of these major index ETFs, even despite all that, and you could see the Thursday reaction, that was tremendous. So even when they really don't get the good news, if they've got the idea in mind that we're going to really get the bears this week, we're going to really stick it to them, we're going to run stops, they're just going to do what they want. And then there'll be somebody with an explanation to tell you why that's legitimate and why that's the case. And maybe it isn't. Maybe it's just the internal plumbing and Wall Street doing what they do. But we'll take a quick look at the diamonds here. Again, I don't want to belabor this. This is a little different. You can see I've got the triangle drawn for us there. And I think, right, the way that just so everyone knows, the way that I approach triangles and things like that is I try to evaluate a lot of factors of them. But there's a lot of people that love triangles and love to really take apart triangle price structures and things like that, how they were traced out, and volume accompaniment, all in all. A lot of things happen. People like triangles. And I think there's a good reason to it, because we know that usually when you leave the triangle, you get a strong move one way or the other, and you can have head fakes above that then reverse and vice versa. But one key thing for me has always been the incoming trend. Right, what was the incoming trend here? Well, I think it was an intermediate term bullish uptrend that was very strong, going to this corrective triangular behavior. And now here we are, and we're working our way towards the apex of the triangle. We're not quite there, right? Probably not quite 3/4 of the way there when you really start looking for the breakout. Sometimes when I have an inkling what I think is going to happen, pretty strong one, because it's based on research in a stock, I'll put on what I call the stake in the grass trade that anticipates the breakout. But most of the time, I would just wait to see. Put an alert. If it gets near there and you start to see things really start to pick up, maybe trade the breakout, right? But until then, it's probably better just to wait to see, let them show their hand, and just keep in mind that breakouts offer false of triangles can be false as well, right? So you're never really out of the woods until the stock is really on its way. Then you start getting out of the woods a little bit more. But when you're anywhere near here still, you know that it can be false and so on and so forth. So you got to be cognizant of that. But right now, this is probably not the most interesting area. You can see you're kind of wedged in here, and you probably need to wait and see what happens. You probably really need to wait and see if you break below or above those lines, and you could put alerts just in front of them to get tipped off to it if you like trading the diamonds ETF. But this is, when I look at the RSI readings, none of them intimidate me here, right? This is very middle of the road, as you'd expect it to be after the consolidation. So as far as I can tell, it's in good shape. What I would say, since we're doing macro measure, and I'm doing this really quick version of it because my super long one had a problem on the recording, I would say, look, this is something worth keeping note of. We haven't covered this a lot lately because it kept trending down and hasn't really mattered. But in terms of like turning the market around, it kept, in other words, it kept the market's trend in place. We focus on other things. I think it's worth this now, taking a look, worth looking at it, because I think now, look, this is a kind of a strong couple of days here. So after the run we've had, could the dollar start working its way back up, which isn't really good for the market? So yeah, you ought to keep I think you ought to keep your eyes on that. This has been a pretty, substantial correction, clearly, right? Luckily we caught a lot of overdone stuff up here that we were not caught off guard by that. That was very helpful. But yeah, you should start maybe keeping an eye on this again and see what happens. See if it can start to put more constructive price action together. And that probably wouldn't be good for the market because of the run we've had. It might help bring the market back down a little. But I watch that all the time. It's one of my key charts on one of my grids for kind of gauging what's going on in the market in real time. Helps me, I think. Excuse me. 10-year yield. We've been charting this too. This is, as we said, this got similar, backed off, and it kind of does move, I think, with the dollar to a degree. And you can see this also started to show a few signs of life. So again, found the 200. Now remember, this is the yield. It's not really the price of the security. So it's a little weird what we're doing here, but you get the idea, right? That this this action though is short-term reversal attempt, right? That might be unfolding, and that would mean that yields are somehow climbing back up. I mean, it seems like that maybe has a shot. There might be a good reason for that, but usually that's not a good sign, for the market. I think the market would obviously prefer to see the yields come down. Better for stocks, better for consumers, companies, so on and so forth. So maybe causes some people to take some profits that have been trading more so than investing. And then let's look at the VIX. So the VIX put a 17 handle in. I think it was on, there you go, on Thursday, almost got into 16 handle. So that's really pretty serious destruction, right, from where we've seen it. We go back further a little bit, you'll see that you got to go back a ways to get to, what's that say right there? That's late, late 2021, very early 22 to really get back to that kind of a level. So it's been a while since we got down that far. This could be very interesting if they're able to work things up in February, kind of the way that I'm thinking, if they have a shallow pullback and then get the bulls charging again, extend this leg, run more stop, set an even more impressive bull trap up. I think you could see this thing trending back towards that 16 to 15 area for sure, which you haven't seen, quite a while. You didn't see it at all really last year to be that low. And if they do that, I think that would be a good point to start nibbling at the very least in terms of the crash protection puts that we talked about in the Phoenix that Ron, our friend and departed friend and partner, used to talk about a lot. That was a big thing for Ron. I'm not really big on that unless you're a position trader, very, very active day in, day out position trader. Then I think it makes a lot of sense. I'm more of a player that way, of just getting involved when you think you've gotten extremely bullish and then positioning yourself. But I would wait until you feel as though that extreme has reached an extreme. That's how I like to do it, because you can always jump in the short run and still trade the downside, get some puts and get started. You don't necessarily have to have it, but I don't like to stock up on them and have a lot of outer month theta to the downside unless I really do think there's an extreme, or I'm able to really manipulate my position day in, day out to capture enough theta to kind of pay for those, the ownership of those crash protection puts through short-term premium collection that offsets that longer-term theta. But that's something for people that are position traders that are really, I think, doing this, very diligently, almost on a daily basis, making an adjustment. So just a different philosophy. Everyone's got to do what they think. But that's that on there. I'm trying to think of what I wanted to show, because I'm just got to admit I'm a little frustrated of what happened to me on my recording. But I think this is really it. I probably should talk about this and then just my little public service announcement, kind of cathartic comments I want to make. This is early 23. You've got to go back to early 19 to get McClellan's summation index reading that's this high. So let's kind of overlay that against SPY, and you'll see that this is really a sign of strength. And it takes a little while, really a sign of strength here, but you've got it all the way up here. And you can see after that in 19, you're right about in here, and it did have a little bit more to go. Then we had to back up, but ultimately, right, that you just stayed really strong. So the bulls have really brought a lot of people in, I think, and they brought a lot of stocks in. And I think they're on the verge of a breather on top of it. You can see a little bit of potential rollover on some of these breadth measures. They're not all applicable to daily charts, so I wouldn't get caught up in too much here. But bottom line is, I think you look at these and they've really improved, which is why we've been more willing to go along with this bullish action that we've seen. But I do think they're kind of showing you that maybe you got too far, maybe some of this froth is going to come out, and then you wait and see. And you say, well, okay, well, this is the context I'm operating in. I have this bullish potential trend change. I've got to wait things out. Let's see if this comes down, finds support where we think it should. If it does find support, then it turns and starts to act impressively again. And if it does, get involved, trade against the recent low, expect it to challenge that high, gets back up to there, trim and roll. If it goes through, then you let your roll keep going. And you keep playing this thing and say, okay, I don't know if it has too many more legs, but it keeps going. And then when you get to critical levels, where you get beyond critical levels, you do the same thing. You keep trimming and rolling. You're just rolling whatever you think, a combination of both. But I'm looking at it like I don't think this will be it, and then they'll just be straight down from here, right back into bull market. I'm sorry, right back into bear market still. I don't think they're just going to say, okay, now that you all know news could change that. But Ryan made this kind of made this point at cocktail hour that it might take a little while. Now that everybody's kind of whipped up and thinks it's great, that might not just be an instant thing. It might be something that has to play out over a little bit longer term, in terms of at least maybe a few more weeks to a few more months. We'll see. I mean, anything's possible, but I kind of think it was a good point, because usually, right, they come up above critical levels and then they test them on the way back down. And you kind of did that with the 200, right? And let me just make that larger. Right in here, they got above the 200, fell back down, couldn't hold it. So the test failed. But they took it back up through the 200. Remember, that's this violet line right here for me. They came back up. They were able to hold it above there. Dropped down below, but they were able to scoop it right away and bring it back up. That kind of closed at new highs or near new highs. Then took out the line we were talking about that everyone's got on their charts, came back, looked like it failed. Of course, with the Fed and all that looming, you know that there's going to be this kind of stuff happening where they shake people out right in front of this. That's what they do. Get it back above, it holds. So that kind of got tested in the short run. But that instant test might need to have another secondary test or something near there. That's why I'm thinking that really this could fall all the way back down towards the 400 level if there is a quick give back, because we got a little too vertical. And one way to see that would be to take a look at the weekly ATR, and you could see that that's about 17 nearly, right, for SPY, the way that I'm calculating it. So really, even if they opened and had an awful week that pretty much went straight down, you could see 395, right, in terms of the ATR. Now, we just use it as an average, kind of like a general guideline for what to expect, but that is not something that would be, I think, typical. But you do have your weeks where things can be really ugly. Clearly, there's one right there from high to low is about 15 points, it looks like. So yeah, you could have that too, but I don't think it's going to fall quite that far if they do bring it down. I don't see them immediately goosing it. If anything, if there's a bullish scenario for the week, I think it's that they kind of sideways it for a couple of days before trying to go after it again. That would be my bullish scenario. I'd be very surprised if on Monday they're able just to jam it right back through. Now, maybe there's news I'm unaware of. Maybe there's news that will hit later today. But I'm really more inclined to think there's going to be a little bit sideways or pullback before these guys are able to really gear things up again. And that would change if levels aren't held, right? The worse that it gets, the more concerning it gets. And if they're unable to hold here or here or here, like the levels we talked about, we just keep seeing how far it's going to fall and expect it to go to the next level once it drops through one level and can't hold there. That's what I mean by like incremental charting. I just kind of follow it as it unfolds and just keep reacting to it. And you got to gauge a lot of other things while you're doing that to see if you really have the right lean. But as long as you're kind of getting that across the board, no, this is not good. The market's not acting well. They're taking a lot of profits. There's a lot of retracement happening. Froth is getting taken out. The short-term froth is getting taken out. That's when I let the things, breathe a little bit more. If it's kind of mixed, be more inclined to be a trimmer than a roller. If it's more clear, I'm more inclined to be a roller than a trimmer. So depending on what I've got on. But I think it's gotten a little bit ahead of itself, and you wait and you just see how things shape up. And if you do trade, if it does burst through right away, which would surprise me, but if it does, I would still trade it, but I'd be on a really short leash because I feel like this was very, very vertical to go up 4.5% as quickly as they did. And after what we have seen, and I think that calendar was used to perfection, right, between the Fed and the mega cap tech. So they got, I think, a lot out of that, and they got extended and frothy. And I think now they just need to bring it back in a little bit. And we'll see what happens. Again, it's always a judgment call what happens from that point on. But I'm going to wrap up just on a brief note because my other video just did not work out. But I just wanted to let you know that this might be a time for you to go take a look at UOA or UOA Essential or TNT, Rebel Pit, Rebel Weekly, depending on what services you're in. But I can speak for UOA Pro and a little bit for UOA Elite and Essential too, since I'm in Elite all day and I'm with Ryan and I'm working in UOA Essential as well. But it's just been incredible. I mean, the opportunities that Mikey and Chris and Brian have helped to uncover in UOA Elite that I've been able to fortunately pull out of into UOA Pro, because the idea is to pare down dramatically. So if you've never seen UOA Elite, I could try to go back to a busy day and you'll see that we want to try to bring this list down as much as we can, but there's some point you're overdoing it. So on a super busy day like Thursday, you can see like it seems like every few minutes, right, there's another hit. This is Mikey, Chris, and Brian McCormick producing all these. This is going on, from the start. So that's a really busy day. Tesla, spiders, IWM, it just goes on and on and on. So I'm in there pouring over that, trying to narrow that down. Instead of like putting 40 or 50 new ideas on, right? I'm trying to whittle that down to maybe somewhere around 5 if I can. Sometimes it's just too good to not put more than that in. But the idea is to do the work for folks that can't do it for themselves all day, to try to pick your way through to find opportunities in UOA Elite, and then give folks a look at those, kind of a very condensed look relative to UOA Elite and UOA Pro. You can see, let's try to look at the new ideas on Friday. Microsoft, we were willing to trade in both directions. The Qs were a shoehorn. I had to kind of force that in the SPY bear trade on from higher levels, because I thought, let's set up our trigger levels from a higher place now that it's ran. And then this BX idea. So on that particular day, there were really only 5 new ideas. Other days, you can see if you see anywhere that says new, if you look at Thursday when they were really busy, I had 3, 5, 6, 7, 8 new ideas on that particular day. But I just wanted to note that you can sign up for this, and you can take a look at some of the recent ideas we've had. And you could always, of course, ask questions if you're there in the forum or whatever. But I'm telling folks about this because it's been incredible. I mean, the finds that have turned up between like AI, Qualcomm, paper leading up to Meta, it just goes on and on. I mean, it's just been Carvana, Coin, AI is another big one. NVIDIA, AMD, General Motors, SI, Piton, FedEx, IWM, QQQ, spiders, XOP is a bear, Apple is a bull, ARC is a bull, Roblox, Microsoft, LAZR, RDFN, Meta, CRM, and QCOM. There's just some of the names I've got listed here that made just remarkable moves. And if you go and take a look in here on a 30-day trial, then you'll see what I'm telling you in terms of opportunity. And I just feel as though, I could be wrong, but I feel as though there's a lot of opportunity. More people could be taking advantage of these opportunities. There's been incredible trading, I think, for the year. I hope it stays like this all year long. I really do, because it's just been great. And if you're willing to trade in both directions, you're really in cooking with gas, as they say, in terms of opportunities to seize upon. So I just never do that, but I really wanted to encourage people to go take a look. If you've ever been thinking about it, right? If this market stays this active, and remember, I can't, make that happen. I'd love for it to stay this way, but that's the thing. People think it's great. The only thing I can give us credit for really is that when the markets are rocking and rolling, we try to get even more active, right? We have influence over that, but we have no influence over the movement, right? So the fact that there's been great opportunities is a function of the marketplace, not really of us. But the good thing is, through UOA, through the technical work that we do, et cetera, all the other things, we're able to put people in a position to look at these in a timely fashion and possibly become involved in these ideas at the right time. And that's what we try to do, right? That's really what we try to do. And I know people have been doing really well, just not enough, like not as many people. I mean, I'd like to see even more people really do exceptionally well, right? That's what the company's here to try to do. So everybody wants to do their part, but I just wanted to share that because it might not be a bad idea, even if you just use it for some intel and say, wow, I can see how some patterns form in UOA and how that kind of maybe is a precursor to the next kind of movement you see in the market or a sector or in stocks or whatnot. It's not a bad thing to explore. So I just wanted to pass that along. And again, thanks for tuning in. I hope that something I shared with you helps you out this week or in the future. And I'll be in touch through our webinars and so on and so forth this week. Thanks for tuning in.